The broadcast is now starting. All attendees are in listen-only mode.
Neil, while we wait for the last few registrations, I thought we might just have a bit of a quick chat before I formally introduce the webinar. It's been an interesting time, not only in America, which we're going to hear about shortly from you, but also in the Australian landscape, particularly politically. What are your thoughts on the recent changes and the impact of the Labor leadership on the Australian market?
Well, I have this rather unfortunate view that in the short run, politicians don't matter to investors. It's only in the long run, when they do make serious changes to the economy, that they can have an effect. Thus, the economy did benefit very considerably from the Hawke-Keating reforms of the 1980s, but it took 10 or 15 years to flow through. So politicians in the short run don't have a huge effect, but that said, they are quite capable of stuffing things up.
And it's an interesting move for Bill Shorten not to be in the financial services role going forward.
Well, financial services has been an area of great importance to the financial services sector, but for members of whatever party who end up with that job, it tends to be something of a poisoned chalice, because you can't win in a sense which will bring you any extra votes. So it's a job which most politicians would really like to be out of, and is somewhere where they can have a high profile that the electorate can identify with, and will increase their popularity and win them votes.
Yeah, look, I think it's going to be a very interesting next few months as we head towards the election. Given, Neil, we're just over 2 o'clock, what I might do is just sort of kick off in respect to formally starting the webinar. Thank you everybody for joining us. My name is Noel Lord from Tailored Consulting Services, and I'm facilitating this webinar on behalf of Millinium Capital Managers today. To kick off, let me introduce to you the Millinium Capital Management business. Millinium is a boutique funds management business with core expertise in investment cash, fixed interest and Australian equities. With a conservative approach to managing clients' money, Millinium believe in a high conviction focused approach to their portfolios. In short, they look to produce a positive return regardless of the directions of the financial markets. Neill Colledge is the head of Australian equities at Millinium and has a significant pedigree in funds management. Having spent over 30 years managing money, and experience of those 30 years, 17 of those at QIC, managing $11 billion in Australian equities. And over that time, Neill's portfolios outperformed the S&P ASX 200 index, which was a great outcome for the investors. At Millinium, Neill is the head of Australian equities and works with his team to deliver consistent returns for their investors, and recently was awarded a 5-star ranking with Morningstar. Neill continues to outperform the market and his peers in his portfolio. Today, Neill is going to talk to us about America the Beautiful, outlining for you his view on the US market and the impact for investors. There will be an opportunity at the conclusion of the presentation to ask questions by either typing in your questions in the chat box on the right-hand side of your screen, or by clicking the button in the question area, which will identify if you have audio available, you can ask your question via that mode, which I'll facilitate at the end of the presentation. So I'll now hand you over to Neill Colledge, the head of Australian equities for Millinium Capital Managers.
Thank you very much, Noel. What I'm going to say to you today is very simple, that despite the recent upsets in Federal Reserve's monetary policy, despite the ongoing confusion with the US budget, despite an anemic economic recovery, the US is going to be better than Australia over the next few years. First of all, we look at the way housing is recovering in the US. Now, as you all know, the GFC was essentially caused by a lot of homeowners borrowing much more than they should have, and banks making foolish loans to them and so forth, so that when house prices fell, the homeowners ended up underwater and the banks ended up insolvent. 6 years after the peak in house prices in 2006, prices began to recover last year. This year so far, and we have figures up to April, we can see that the recovery is sustained. House prices for existing homes are actually up to 12% year on year. Now this only takes house prices back to the levels they were in 2004, and it's still 26% below the peak level. But the important point is that the uptrend has been sustained. We can see this not only in prices, but also in volumes. Existing home sales, latest figures, show they are now the highest level since 2009, i.e. when the GFC was well underway. New home sales, similarly improving, highest level since July 2008. So what we have is a definite uptrend in US housing. For the consumer, this is very, very important because it means that their wealth is being slowly restored as the value of their equity real estate increases. At the bottom of the GFC, more than a quarter of US homeowners with mortgages were actually underwater on their mortgage. And that was when homeowners' equity as a total percentage was under 40%. Since then, it's now reached 49% of total real estate value, and the number of homeowners who are underwater is now down to about 20% of the total. So they're not out of the woods yet, but things are definitely improving. The recovery in housing has another important effect, that it will eventually drive GDP growth. For the last few years, the fall in housing starts has meant that housing has been a negative for the economy. If you look at the chart in front of you, we've split it into two. The important one is the blue line, because that's single-family housing. And you can see very clearly that that is where the boom was. Multi-family housing, apartment buildings and so forth, didn't enjoy the boom. It went down a bit, it's recovered a bit. The real swing factor here has been the single-family home, and the number of starts there collapsed from the peak of 700,000 per year down to less than 100,000 per year, i.e. a fall of more than 80%. Since then, that's improved. It's almost doubled, but it's got a very long way to go before it reaches a long-term trend, and certainly won't reach the previous peak in any hurry. But this shows you the amount of potential upside there is for the economy and even the present recovery in housing. Second thing I want to talk about is jobs. Employment is not recovering as fast as housing, but it's recovering reasonably well. The US still has not made up the number of jobs which it lost in the since the GFC and the recession. It's still 2.5 million fewer jobs shorter than there were before then. But what we can see is that the unemployment rate is falling. It's now down to 7.6 from a peak of 10%. And at the same time, the absolute number of unemployed is falling quite steadily. Now, one of the negatives here is that governments, state, local, federal, are still reducing jobs, and at the same time, private sector jobs are still very, very anemic because economic growth is low, which means that businesses are not prepared to spend money on capex for new buildings, new enterprises, or anything like that, which means there's not very much job creation. So employment isn't recovering as fast as housing, but there's a definite trend of recovery. As you can see in this chart, we show the number of unemployed people who are looking for a job divided by the number of job openings. And at the peak of recession, it was really, really awful. I mean, if there's six people looking for every job, your chances of getting it are pretty bad. Since then, it's halved. There's only 3 people for every 3 unemployed people for every job opening. So it's improving. It's still worse than the long-term trend, but it's not too bad. The negative is very clear in these two charts here. We can see that collectively, if you look at the economy as a whole, it is adding jobs quite steadily. It's been doing that since the bottom of the recession. But again, if we split this into, because that's a net figure, if we split this into new hires versus layoffs, we can see that most of the improvement comes from the absence of layoffs. Businesses have stopped shedding workers, but they're creating new jobs only at a very, very slow rate. And this comes back to the very slow pace of economic growth which we were talking about. So these two factors together mean that the consumer is doing better, but they're still nowhere near where they were before the GFC. The stock market recovery over the last 2 years has been spectacular. You've seen, for example, the S&P 500 more than double, but most people do not own shares, and most people do not own a lot of shares unless they're in the top 10% of the population by wealth. So the stock market recovery is mostly benefiting the well-off. For the poor, those who don't own a lot of shares, to do better, to see their net worth increase, they're going to need further increases in house prices. And that will happen, but it's not happening very fast. On the other side of the consumer balance sheet, we can see that although their asset prices are improving, at the same time, they've also reduced their debt. The debt-to-income ratio has fallen from its pre-GFC levels back to reasonable levels, and again will probably keep on falling further. The net effect of this improvement on both sides of consumers' balance sheets has been that consumer confidence has now reached its highest level in more than 5 years, since before the GFC started. So the conditions are set for continuing recovery in consumer spending, which is important because consumer spending is 2/3 of US GDP. And this chart simply shows how clearly that household net worth has not recovered. If you take it on a purely dollar of the day basis, nominal household net worth, it looks pretty good. But if you start factoring in inflation since the peak in 2007, it looks fairly awful still. And households know this. They know that they are not as well off as they were 5-6 years ago. The fourth factor is that the corporate sector. Corporate sector actually has been strong throughout. If you exclude banks, the corporate sector went into the GFC looking pretty damn healthy, and there have been relatively few bankruptcies, insolvencies and so forth amongst larger companies. In fact, the fact of low interest rates has encouraged many companies to either refinance their old debt at new lower rates or indeed to take on new debt. Now this has an effect on companies' balance sheets. Because they're not spending very much money on new capex, no new buildings, no acquisitions, because they're not hiring more people very rapidly, companies are building up cash. Even after they increase the number of share buybacks, even after they pay more out in dividends, they're still piling up cash. Currently, the figure is about $1.5 trillion US. And what we see this not as a problem, but rather a cash mountain which will serve as fuel for earnings growth when the recovery accelerates. Companies will begin to draw down on their cash in order to increase capex, in order to fund new acquisitions, in order to hire more people. And you can see that the problem is not corporate profits. Companies may complain that the government's against them, there's too much regulation, there's too much foreign competition, etc., etc. But corporate profits as a percentage of GDP are at near record levels. So the problem is essentially that not that companies aren't making money, it's just they're sitting on their cash because they can't find profitable ways to spend it. In particular, you can see that here, although corporate cash is slightly below its peak level immediately after the GFC, because corporate boards are getting a little less scared than they were, it's still at levels well above the average level of the last 40 years. And the reason is very simple. Corporate capex has been very low. Only in recent months has it turned positive for things like computer equipment and software. Major expenditures on new buildings, plant and equipment are still very, very low. The sixth factor is the government. And as we pointed out, governments are still shedding jobs. This is mostly involuntary. The budgets of state and local governments in the US almost always have to be balanced each year. So they do tend to be follow the cycles in the economy. But there is a gentle upward trend here. Federal budget is a whole story by itself, and I'm sure you've read lots about that, so I won't go into any great detail. But in fact, although the US government has a problem with the budget deficit, that budget deficit has been steadily falling this year accidentally. The fact of congressional gridlock has meant that tax rates are actually higher because past tax cuts have not been extended, and there is an automatic spending cut program known as the sequester, which is reducing government spending by the federal government not exactly at random, but sort of all sorts of weird places. So in time, the US government is capable of fixing the federal budget, but there are two major difficulties in here which do require substantial rethinking, changes in attitude and changes in policies. And the first is just defence spending, which is fairly obvious. Defence, if you go back 10 years, the US was actually running a surplus at the federal level. What tipped it into the negative, caused it to run deficits, was starting wars. First of all in Afghanistan, then Iraq, and the fact that these continued for a decade. Its defence spending has been a big factor in driving the size of the US government deficit. The only way to stop this is for the US to stop finding new places to lose wars. The other big problem for the federal budget is healthcare. And this is not a government problem, it's a US private and public sector problem because US healthcare spending is totally out of control. It has been higher than CPI for the last 30 years. It is now 17% of US GDP, which is twice the percentage of GDP of every other developed country. In fact, the per capita spend is twice the level of every other developed country, and you have worse outcomes. You have lower life expectancy, more problems with obesity, etc., etc. So although we don't think the US budget is a huge difficulty, in the long run, any US government will have to solve the problems of defence spending and healthcare. Now you can see how all these factors fit together. This shows the contributions to first quarter GDP growth numbers as revised. The first two items are government, and you can see that these have been negative. And this is even before the sequester started. So in the next quarter, they'll be even more negative. If you look at the remaining items there, exports, not very much effect. Business capex, which is the net of business equipment and business structures, net not very much effect, pretty flat. Residential investment, small positive, going up. That's the housing start we referred to earlier. And personal consumption expenditures, the biggest single contributor, because this is 70% of the US GDP. And consequently, changes in inventories as businesses stock up slightly in advance of expected economic growth. So the big drivers there are extremely obvious. Consumption is the main thing. Most of the rest of the economy is not doing very much, except for housing, which is slightly positive, and government is a drag on the economy. Net, though, what we take away from this is that the US economy is, in fact, in uptrend. It's not a great uptrend, it's not a rapid recovery, but it's a definite recovery. We can see in particular the housing sector is adding to growth, that there is fuel in the cash mountain for job growth to pick up when business investment picks up, and the consumers are slowly restoring their balance sheets. So things are getting better in the US. This is not like Australia. As you well know, Australia is suffering the end of the mining boom, and that means that over the next 3 years, US economic growth will definitely be faster than Australian economic growth. Another consequence of that is that over the next 3 years, the US will net be stronger. That is, it will continue to rise, not on a month-to-month or even quarter-to-quarter basis, but the economy is going much better in the US, and Australia faces the end of the mining boom. And as we've learned from mining booms over the last 150 years, the downturn is always worse than we expected. There is almost always a recession out there. Commodity prices and volumes almost always fall by more. So, conclusion for that's very, very simple. Investors should have less money in Australia and more money in the US. The simplest way and cheapest way of doing this is US index ETFs. But since I'm talking about Millennium's dividend income fund here, I need to explain that what I've just said, all this about how wonderful the US is compared to Australia, actually has an impact on how the Millennium portfolio is constructed. It's not that we put in a higher US dollar figure and a lower A dollar figure and say, gee, we ought to own more Australian companies with US exposures. It works on a stock selection basis. That is, it changes our forecasts for companies which have US operations. They tend to have more rapid growth in earnings and dividends and cash flow. And this is why a third of the companies in our dividend income portfolio at the moment have US operations, simply because, not that they're intrinsically better or because we're trying to play the A dollar, we simply see that their earnings and dividends and cash flows are going to go faster than the average Australian company. Before concluding, I need to say very briefly that the end of quantitative easing in the US, which has disrupted bond and equity markets immensely over the last couple of months, is not a disaster for the US, but it is going to mean that the next 12 to 18 months are going to be rather more exciting than one would have hoped as an investor. Although the normalization of interest rates means that long-term interest rates are going to go back up, the average level, the absolute level, will still be low in historic terms, and the key things we need to take away from this is that there will be a bumpy road because the Fed will miscalculate from time to time. It will be too optimistic and too pessimistic, but cash rates themselves will remain low. The Fed is committed to keeping its cash rate at as low as 25 bips for the next 2 years, so you'll end up with a steeper yield curve. Consequence of that is that you will see more corporate defaults. We said earlier that corporations went into the US downturn with strong balance sheets, and most of them will come out fine. If you look at the S&P 500, 495 of them will be perfectly okay. The last 4 or 5 will have difficulties because they'll have taken on too much debt, there will be changes in their industry, they'll make management mistakes, and you will have more corporate defaults. This will be negative for junk bonds collectively, because junk bonds have been wildly overpriced for the last year and a half. So when we say that you should be in the US, we cannot emphasize too much that a great deal of care is needed in selecting exposures. Hence recommendations for index funds, index ETFs, because if you buy the S&P 500, for example, as an index, then you are essentially buying the 500 largest companies in the US. Their average figures are fine, and only a couple of them will get into trouble. So your downside there is very limited. But for individual companies, even Australian companies which have US operations, a great deal of care is needed. And that is why we have been absolutely rigorous about thinking about the dividend incomes exposures to the US, because as you know, the dividend income fund is a fund whose primary focus is low risk, i.e. not losing capital. Now, in a moment, I will be happy to take any questions you care to throw at me, but let me just tell you a piece of very positive news for Millinium. We are being joined by Marcel von Pfeiffer, who is our quantitative specialist and is about to run an equities fund for us. Marcel has excellent experience, not just as a quant, but also as a strategist in stockbroking globally, and you can see there the number of people he's worked for. Some of you may know him because he's worked for Morgan's here, but he will be an excellent addition to our team. And Marcel is here with us today, but let me hand you back to Noel to ask any questions which you may.
Thanks very much, Neil, and welcome on board to Marcel as well, which is great news for the Millinium business. Neil, I do have a number of questions that have come through. The first one is, given your view on the US, what sectors in the Australian market are you staying away from, and what sectors are you attracted to?
We stay away from resources, and then that's essentially a view about US growth being slow, steady and improving, but slow. You're not about to have any growth in the US which will offset the downturn in China. So the commodities boom is over. Commodities prices are headed down. Again, they're not going to all fall immediately, and they're probably not going to fall as fast as they did in the last 12 months. But the overall trend for the next couple of years is down, so we stay away from resources, and we also stay away from sectors dependent on that, such as mining services. On the positive side, what we look for in a company is not so much a sector as an actual operation in the US which is profitable and has a good outlook for its industry sector. And that may be as diverse as Ardent Leisure, which owns bowling alleys, or it may be CSL, which provides blood to about a third of the US hospitals, it can be any operation at all, and again the key factor there is not the A dollar or indeed the aggregate US growth. It's the particular characteristics of the company and the industry it operates in.
Great, thank you very much, Neil. The next question we have is, you mentioned obviously your resources are out of favour in your opinion, and what has the impact been on your portfolio by staying out of resource stocks over the last period of time?
Okay, the Millinium Dividend Income Fund in last financial year, FY13, achieved a return of 33% against the S&P ASX 200's 22%. That 11 percentage points of alpha is about half due to holding things which went up, and the other half is due to not holding things which went down. Last year, the big losers were, of course, the big resources stocks, and we didn't own them at the start of the year. We don't own them now, and there's no prospect of owning them in the near future. So about half our outperformance of the index last year was due to not owning the resources sector. But that's not a constant. In previous years, it's been less than that, simply because the resources sector didn't fall as fast. And I emphasise it's not an absolute aversion to the resources sector. It's the nature of the way we build this portfolio that we expect to make about as much from the things we don't own as we do from the things we do own.
Great, thank you very much, Neil. Neil, in relation to the financial stocks, does your portfolio have a limitation on how many of the banks it holds, or what's your view on holding the banks?
We do have a limitation. We have an absolute limitation on our exposure to any one sector, which is 30% of the portfolio. What we hold in the banks is below that, and it's always significantly below that, because this is a hard constraint. We don't expect to run up against it. We own the banks because they have relatively little downside. As you know from our experience in the GFC, Australian banks are a protected species, but more to the point is the fact that they have cleaned up their act very considerably since the GFC. They went into the GFC with much weaker balance sheets, i.e. much less in the way of consumer deposits, much worse loan books, and they've done a lot towards cleaning up both of those. So the GFC served as a reminder to the banks to get their act together. If you go to a bank now, and especially if you're a property developer, you'll find it very, very hard to get any money out of them whatsoever, which is a good thing from the investor's point of view. It's true that growth in the banks is low, that loan growth, whether it be housing loans, business loans, anything, is low, but that's fine so long as you adjust your cost structures down to meet that. And they have been, all of them, reducing costs. So we are happy with the outlook. We don't think they're particularly cheap at this precise moment, but that's not how we choose stocks. We choose on the basis of not having very much downside and having an expected return above the market. It need not be a long way above the market. In fact, it almost certainly won't be a long way above the market because the Dividend Income Fund is a low-risk fund, but we do expect them to do okay over the next few years, along with most other regulated sectors.
Great, thanks, Neil. Well, ladies and gentlemen, thank you very much for attending the webinar today. I'm sure you'll agree with me that the information was very easy to understand and beneficial to getting a better understanding of the dynamics of investing in equities and the impact that foreign markets can have. The team at Millinium look forward to working with you in the future and continuing to deliver outstanding returns for their investors across their portfolios. It certainly is a very exciting time for Millinium Capital Managers, with not only the continuation of their stellar performance in their portfolios across cash, fixed interest and Australian equities, but with Marcel von Pfeiffer joining as well, Millinium's really looking to take their business to new heights. If you'd like to know more about the Millinium offerings, please make sure you contact either Monty Granger or the Millinium office directly. If you would also like a copy of the webinar, they can provide you a copy with a link that's a recorded copy of Neil's presentation, and we do thank you for